worst day on Wall Street since the crash of
The
1987.
Dow traders are standing there watching in amazement. I don't blame them.
We're now down 43%.
Almost everything there completely wiped out. And the NASDAQ, everything and more has been completely wiped out.
Let's talk about the speed with which we are watching this market deteriorate.
Hello, ladies and gentlemen. Welcome to another episode of the weekend edition, Markets Around the World. My name is K2, and I hope you're having a great weekend. Unfortunately, the start of the year has been tough for many, especially in California, where wildfires have caused devastating losses. I want to extend my prayers to everyone affected by this situation, especially the families who have lost their homes. I wish you all a speedy recovery. My heart goes out to you. I truly understand how difficult this can be, having experienced something similar in my own country. With that said, let's dive into today's top headlines. Don't forget to like this video and subscribe to the channel. Do you still have to pay your mortgage if your house burns down? That's the tough question many Los Angeles homeowners face as wildfires destroy thousands of structures. The short answer is yes. Mortgages must still be paid. However, laws provide relief for disaster-stricken homeowners, such as forbearance, which temporarily pauses payments. Homeowners should contact their mortgage servicer to explore options. That said, disaster relief may vary, especially for larger mortgages on multi-million-dollar homes, which might not qualify for the same support as smaller loans. The S&P 500 is up just 0.8% since Election Day on November 5th, barely holding on to the Trump bump attributed to Donald Trump's victory. This marks the weakest performance from Election Day to Inauguration Day since Barack Obama's 2009 inauguration during the global financial crisis. The contrast with 2016 is stark, when Trump's unexpected win sparked a 6.2% rally, fueled by investor optimism over corporate tax cuts and deregulation. A recent surge in U.S. Treasury yields could accelerate after a strong jobs report bolstered expectations for prolonged high interest rates, raising concerns that benchmark 10-year yields might reach 5%, a level some worry could unsettle broader markets. The December jobs report showed employers added 256,000 jobs, surpassing forecasts, while the unemployment rate fell. These figures reinforce the belief that the Federal Reserve will keep rates elevated to address economic overheating. Nvidia stock is heading for its worst week since September, dropping 3.2% Friday, amid broader tech sector pressure following a strong jobs report that heightened inflation concerns. Investors were also unimpressed by CEO Jensen Huang's CES keynote, which focused on long-term vision, but lacked detailed updates on quarterly financials or the company's data center plans, dampening enthusiasm after a strong start to the year for Nvidia shares. Now let's dive into some data. I want to show you guys about inflation. The Fed pivot narrative has officially collapsed. Stocks are tumbling after the U.S. added 256,000 jobs in December, 92,000 more than forecast. The unemployment rate fell to 4.1%, directly contradicting the Fed's claims of a weakening labor market. The labor market remains robust, with the 6-month average job gain hitting 165,000, the highest since July 2024, when the Fed delayed rate cuts. Investors are spooked, fearing the Fed will maintain elevated rates longer than anticipated, putting additional pressure on markets. Here's a recap of the Fed's September 2024 policy statement. In a controversial move, the Federal Reserve initiated its first rate cut since 2008, reducing rates by 50 basis points. This decision faced significant criticism, given the prevailing economic conditions. The Fed justified the cut by citing a slowdown in job growth and progress toward its 2% inflation target. Despite these explanations, many viewed the decision as premature, given the underlying economic resilience and ongoing inflation concerns. However, The economic landscape has shifted dramatically since that decision. Job gains are now accelerating, and inflation is clearly rising again. These developments fundamentally undermine the rationale for rate cuts, as the conditions the Fed cited no longer align with reality. A robust labor market combined with climbing inflation suggests a need for higher rates, not lower ones. This reversal casts doubt on the Fed's earlier decision and raises concerns about its ability to navigate the current economic environment effectively. Still not convinced? Consumer inflation expectations are surging, reminiscent of a meme coin breakout. Following the Fed's 50 basis point rate cut, consumer inflation expectations soared to their highest level since 1980. It seems that nearly everyone, except for the Fed, anticipates rising inflation. This growing sentiment reflects a significant disconnect between market perceptions and the central bank's stance, further complicating the Fed's policy decisions in this challenging economic environment. In summary, the Fed pivot is officially dead. The current base case indicates a 44% chance of no rate cuts through June 2025, a stark contrast to earlier expectations of 5+ rate cuts in 2025. As the prospect of interest rate cuts diminishes, the yield on the 10-year note is approaching 5%. This shift underscores the importance of reevaluating market strategies in light of evolving economic conditions and Fed policies. With inflation returning and consumer inflation expectations reaching over 40-year highs, the question arises, are we on track for a 1980-style rebound in inflation? As we head into 2025, market dynamics and economic conditions suggest that volatility may be the defining characteristic of the year ahead. Investors should brace for potential shifts in monetary policy and market reactions as these inflationary pressures evolve. Now let's add some color to the conversation and take a look at the S&P 500 heat map. Meta Platforms and Amazon were flat for the week. Nvidia was down 1.74%, while Broadcom dropped more than 3.33%. The financial sector was predominantly red, with JP Morgan Chase remaining flat, and both Visa and American Express down 2%. Tesla was up 4%. The healthcare sector was performing well overall, with United Health Group and Eli Lilly both rising by 3%. The industrial sector and real estate sector showed mixed results. Additionally, with Donald Trump back in the spotlight, the energy sector was green so far. The Fear and Greed Index is currently at a level of 27, indicating fear in the market. If this trend continues, it's possible that we could see it move toward extreme fear in the coming week. Market sentiment can be influenced by various factors, including economic data releases, corporate earnings reports, and geopolitical events, so it will be important to keep an eye on any developments that might impact investor sentiment. These are the most anticipated earnings for the upcoming week. As always, the earnings season typically kicks off with major banks such as Bank of America, JP Morgan Chase, and Morgan Stanley. Now let's do some charts that I want to show you. We begin with the first chart I want to share with you. Focuses on the S&P 500 index and its performance after the percentage of stocks exhibiting a rising 200-day moving average fell below 57%. At this point, the S&P 500 was also situated less than 3% below its 5-year high. This chart provides valuable insights into market trends and can help us understand how the index has historically reacted when such conditions arise, potentially indicating shifts in market sentiment and investor behavior. The next chart I would like to present illustrates the relationship between the S&P 500 index and the yield curve, specifically focusing on historical trends observed during the past two major market events, the dot-com bubble and the global financial crisis, GFC. In both instances, when the yield curve transitioned above zero, it was followed by significant market downturns. This chart raises an important question. Do you think we will witness a similar outcome this time? As we analyze the current market conditions and the behavior of the yield curve, it's essential to consider the implications for the S&P 500 and the broader economic landscape. Let's wrap up with key events for this week. On Tuesday, we have the Producer Price Index, PPI, followed by the Consumer Price Index, CPI, on Wednesday. Then on Thursday, we'll see initial jobless claims and retail sales data. All right, folks, that's a wrap for this video. If you enjoyed the content, don't forget to like and subscribe. If you have any questions or thoughts, feel free to drop them in the comments, and I'll respond as soon as possible. Thanks for watching, and I'll catch you in the next one. Take care.